Right, I think we're going to crack on. So today, instead of actually jumping into what I want to do today, I was going to actually look back at what we discussed last time and something I actually forgot to mention in my previous video, and I wanted to show you a live demo. So, as you may or may not know, the US stock market is actually open right now. They close at around 9 p.m. UK time. Wait, yeah. No, wait, they don't. They're closed right now because of daylight saving. Sorry, this is messes with my head all the time. Anyways, so what I wanted to focus on was liquidity and the bid ask spread. So, Apple is like a very famous stock, right? Like a lot of people have Apple in their portfolio. It's one of the big, it's one of the most, it's one of the biggest companies in the world. And a lot of people tend to trade Apple as well. So you can see for $120 stock, the bid ask spread is 1 penny, and that's the lowest bid ask spread you can get on the market, except when you're dealing with penny stocks and stuff like that, which are worth less than a penny. But yeah, for Apple to be, it proves the liquidity of Apple, of how frequently Apple is traded, by retail traders as well as by the bigger institutions, so to speak. Another penny stock is Zomodica, which is like a medical company. I don't exactly know what they do. I just know they're a penny stock. Good for them. There you can see the bid ask spread is about 2 pennies, which is about 1% for a $2 stock, whereas Apple is like a fraction of a percent. This is another penny stock I just randomly found. So basically, a penny stock is any stock worth around or less than $5. That's just the general blanket that covers penny stocks. So you can see the bid ask spread again for a $5 stock. 2 pennies is not a lot. It's less than 1%, which is great. uh, I found this stock by searching for like the most illiquid stock that I can find, and this is one that popped up. Here you can see it's like 13 plus 27, 40 pence for a $14 stock. So this tells me that this is an instrument I don't exactly want to trade or actively trade, just because if I buy this stock and then sell it instantly, I will just lose 40 cents for no apparent reason whatsoever. Whereas in Apple, 1 penny is like what Apple would cover or move in fractions or in a second, so to speak. So that's what I wanted to point out. That's the takeaway from the previous episode that we had about liquidity and the bid ask spread. They're both related, and they both give an idea of how quickly or easily you can trade in and out of an instrument if you want to trade it, but also long term how you will lose out on the bid ask spread if it's too wide. So there's something worth considering. So let's look at Amazon. Actually, it's like a $3,000 stock. The bid ask spread will be quite significant. It's about $4 here, which is again about a percent, a bit more than a percent. So that's something we can accept, going forward. But if you buy Amazon one share and sell it instantly, you lose $4. Which is a move Amazon can make again in a few seconds if you just wait and watch it move around. That's just something I wanted to cover for the previous episode, but never actually got around to it. So that's just following up from the last time. Right. So let's crack on with today's bits and bobs. Just bear with me. From the current slide, yes. So again, oh, I should have started with this actually. This is not financial advice. This is only my opinions, trying to educate my peers on how they can get investing and involved with the stock market in various ways, be it passive, active, buying, trading stocks, or just buying and holding stocks for what they prefer. Content is being recorded so that I can go on YouTube, as you may have seen some of my YouTube videos already, which is great. Thank you very much for that. So today is the third of 8 episodes or podcasts, so to speak. Today we're just going to talk about some really basic metrics that people use when talking about stocks or the stock market or whatever it is. So yeah, hopefully this should help you understand a few bits or a bit of the jargon really. So I was actually watching a video earlier today, and um, it did explain it really well, that one of the key inhibitors, or the one of the key reasons why people stay away from financial markets, is because of jargon. It's one of the key barriers, the biggest barriers. You can't do something unless you know what the words mean, and that really makes sense to me. Like, be it surfing or anything, rollerblading or skateboarding. Like, if you tell me skateboard bearings, I don't know what size they are. I don't know nothing about skateboarding, so that's something I have to research, spend time behind, and if I'm not interested, I just won't do it. Whereas finance is something I'm quite interested in, which is why I spend the hours trying to learn what the words mean. And so I'm trying to explain, or help you understand, or make it easier for you to understand what the words may mean when you look at them on your app or your website or whatever it be. What I'm going to discuss today are largely to comprehend and analyze the size of the company, to help you understand the size of the company as well as the direction the company might go in. It might, help predict and justify the stock price itself. So when I'm going to tell you about today is just words that people use to try to predict where the market's going, or justify why it's gone where it's gone. For example, so treasury yields is just one word. We don't know what it is, but I mean, in the last episode, you may have heard me mention it as the US government backed bonds. That's basically what treasury yields are. They're up today, they're up again today, which is just 2 days later. And tech stocks have taken a plummet since then. They're somewhat inversely correlated, which now you know how you can diversify in case you want to look into that further. And we will talk about diversification a bit later. Right. So one of the most commonly used term is market capitalization, or often referred to as market cap. It's just abbreviated market cap. It basically gauges the worth of a company as dictated by the stock market or the market itself in general. So when I say Apple's worth 2 point something trillion, that's literally the market capitalization of Apple is roughly $2 trillion. Is basically the stock price or the price of each share multiplied by the total number of shares that a company has issued. This is not issued to the market. This is issued in total. So if a director or the top 10 people own shares, this is their shares are included in the outstanding shares. So even if they are holding 10-15% of a company, if insiders, who are people working within the company, own 15%, and only 85% of the company is left out to the public, accessibly, the 100% is what is counted towards market cap. So looking at Apple a few days ago, I think each share of Apple, if you look, actually we looked at it a few minutes ago, is trading about $120, and there are about 16.79 billion shares in float. Not in float, sorry, in outstanding shares, which is shares held by insiders as well as shares open to the market. And that gives you a market cap of roughly $2 trillion. That's how it's calculated. That's just a very basic calculation, but you can go and do an exact calculation per minute, per second, however frequently, because stock prices are always going up and down. This also helps to divide companies into large companies, which are relatively stable, been around for a few years. They don't get to the $10 billion valuation without, doing a few good things in the past. And these definitions kind of stick today as well. So you've got large cap, medium cap, small cap, and micro cap. So micro cap is 300 million, MN is million there. And that's largely also how they're classified today. So when you go and buy an index fund, for example, that says large cap, now you know that they're only investing in companies worth around 10 billion or greater. So that's just something to keep in mind next time you hear the word market cap and what it actually means. Right, next is dividends. So, a dividend is like a reward or a payment from a company to its shareholders for participating in the venture, or for trusting your money into that company while it may not rapidly grow. So dividends can be like a juicy take that a company might give you, a carrot, so to speak, to lure you in. And they're distributed to recorded and eligible shareholders. This catches a few people out, because companies can issue multiple classes of shares. So each of these classes may have different rights towards a company. So for Apple, for example, 16.79 billion shares, not all of them have voting rights when it comes to the direction that Apple decides to take as a company. So that's a different class of shares. The common shares which are issued to all of us don't have voting rights as such unless we own them in a large quantity. And there may exist a special kind of shares which have stronger voting rights, or they may even have a clause in them that do not allow them to get diluted, as we spoke about dilution last week. So as long as you're holding an eligible share, as well as you're recorded on the X dividend date, which is different from the dividend payout date. There are two different dates. So they will take your name on the record on day X, for example, which is the X dividend date, and they will pay out the dividend maybe a week or several weeks later, which is when you actually get the cash in your account. It's actually a dollar amount that's determined by the management and presented on websites or your apps as a dividend yield, which is shown as a percentage of a share price. What I'm trying to say here is that the dividend, in terms of dividends, it's the value in dollars that is fixed, as decided, just before every fiscal year by higher or upper management. So the dividend yield can actually vary depending on what the stock price is. Uh, AT&T is a very good example here, or even Coca-Cola is one of the, it's called the dividend aristocrat because they've been paying dividends for over 25 years. In fact, they've been paying increasing dividends over the past 25 years plus for Coca-Cola and AT&T. A quick calc for AT&T, you see it's a $29 stock, roughly $30 now. I think they pay 52 cents quarterly, which is about $2.04 per annum. So the dividend yield works out to be around 7.17%. But you will be paid quarterly, because that's what AT&T decides. They can choose to pay you annually or quarterly. Dividend yields can vary anywhere between 1%, 0%. Even most growth companies like Facebook, I don't know if Facebook offers dividends or not. I know Apple certainly offers a dividend, and so does Microsoft. Although the fraction of what they offer is peanuts, it's like 1% or something, because the share price is so high. Even the 1% is like $1 an annum. So it's almost half of what AT&T pays, but the dividend yield shows to be much lower. That's just a quick note on what dividends are. Obviously, you've also got the capital appreciation. So when companies are paying you a dividend, the day the dividend is issued or paid out, the stock price of the company actually falls by the amount of dividend is just paid, and you can see it like a little drop. That's because it's actually taking out cash from its bank or its books or its accounts and actually giving it to its investors. It's cash reduced from the company's books. So the price does fall slightly, and then the company recovers as the stock market just tends to go up over the long term. So if you look at around the dividend dates and zoom in on like a 1 day chart or even a 5 minute chart, you will see a little dip, proportional to the dividend that they've paid quarterly. Companies that do not, obviously, that do not give this dividend don't have this deduction on their books quarterly, so their price doesn't drop like dividend paying companies. And statistically, you'll see these companies grow at a much faster rate relatively to dividend paying companies if they're in the same industry, or if the whole industry has grown in general. Of course, you've got companies being specific, so it doesn't go, as I've stated, as easy as it is. But it's just something worth keeping in mind. So investors now have a choice if they want to get paid regularly, like in the case of Coca-Cola. You just get like 4%, I think, per annum for the last 25, 30 years. So by now, if you invested 25 years ago, you're likely to have just covered a free share of Coke by now, or AT&T. Or you can hold companies that see growth and then just lock in the money in there, and then you have a bigger payday later on, which could be a taxable event. By the way, I do not actually consider taxes in this chat, because that's more of a personal finance thing, and I'm not going to touch personal finance so far unless somebody asks for it. So this is purely assuming no taxes apply, or whatever. So that's capital appreciation. So in addition to that, you've also got some very specific metrics that people, some people smarter than myself have thought about, of how to analyze companies. They try to predict what a company is worth based on these analytics, and they think about words like revenue, which is the income of the company, without, before taxes, expenses, and all that stuff. Basically, the cash they've raised from sales or any other activities. You've got earnings per share, which is the company's profits, which is, after tax, after expenses, after everything, divided by the number of outstanding shares. And you've got your PE ratio, which is the price to earnings ratio. As it is, it's the ratio of current stock divided by EPS, which we just discussed a minute ago. One of my favorites is total debt to total assets. That just tells you how much debt the company owes compared to what they actually have in assets. You got to be careful in what's counted as an asset, because some companies would even put in words like goodwill within their assets, which they quantify. It's actually a number in millions, billions, whatever, that they try to quantify in terms of relationships they have with the customers, or if they're getting taken over, if they're getting acquired by a different company. It's the difference in between the company's assets and what the company is being paid for the takeover, for example. So if a company's assets are worth $1 billion and they've got a takeover offer confirmed for about $1.5 billion, the goodwill on that asset sheet would be roughly 500 million. Of course, it'd be a bit less, bit more, I don't know, but it'll be roughly that much. And there are quite a few more terms out there. You can look into like PEG and stuff like that. I personally don't trade stocks, but somebody like Warren Buffett or any decent investor often looks at one or more of such variables to find stocks worth investing in, or they think might do better or good in the long term. So, apart from your active and passive, you've also got another two camps to think about. People tend to divide their not divide, they tend to stay in one of these two camps, which is to do with value stocks or growth stocks. And you will often hear these words. Value stocks are company that are taught to trade below their real worth. During the pandemic, people were thinking like, the cruise liners, airlines, and all these would be value stocks because they're suppressed right now because travel isn't happening right now. But at some point in the future, it'll all pick up and the stock will be worth more. And that's the value stock thought of train of thought. My bad. So one of the most famous value investors is of course Warren Buffett, who when he buys his stocks, as a hedge fund, as a fund, Warren Buffett has to issue his purchases and sales quarterly in something called a 13F filing with the SEC, which is the Securities and Exchange Commission in the US. So every quarter, Warren Buffett or all hedge funds, all people, all money managers basically have to reveal their purchases and their sales for the past quarter. So whenever Warren Buffett buys something, people just ponder like, what does he see in this stuff, and then next thing you know, 3-4 years down the road, he's worth 100 billion or something like that, which he actually is worth right now, I think. And most of his wealth, like about 90 something billion of his 100 billion net worth, has been growing since his 65th birthday. He's about 90 something right now. So over the last 35 years, that's because he buys stocks he thinks are suppressed, or the company thinks it's suppressed. And then, 10 years later or 5 years later, next thing you know, it's 500% over when he bought it from. So he tends to just wait out the real, the long game, so to speak. Then you've got growth stocks, which are thought to contain future potential to grow super rapidly, like Apple or Facebook. They tend to, they don't actually have a lot of earnings, or their fundamentals are actually quite weak, so to speak, as per value terms. But people think that, Facebook will just keep growing with their user growth and the ad revenue and the VR coming out. I think they had a crypto thing coming out a few years ago as well. So they see value in a company's growth or future plans and then bet on it now to cash out later. And obvious and not obviously, but like typically in a market crash like 2020, for example, growth stocks tend to suffer a lot more than value stocks. But at the same time, in a bullish environment, which is when stocks go up, or when the market goes up, in a bullish environment, growth stocks tend to outperform value stocks quite visibly or noticeably. So there really is no right or wrong choice. I think with all strategies, the investor's end goal is to try to outperform the standard market returns, which is as determined by an index of an individual's choice. So, of course, I've got a whole episode of indexes coming up next, which is actually episode 4, I believe. So don't worry if you don't know what the word means. We're going to talk about it later. But it's trying to outperform a benchmark, basically. And that's what the end goal of every investor It is. I hope so. I mean, nobody wants to underperform what the market does, because you could just put your money on the market and watched it grow. So, nobody wants to underperform the benchmark, so to speak. Right. So, the metrics I defined in the last, 15, 20 minutes will help you identify potential corporations worth investing in long term. Obviously, you can look at the PE ratio or the PEG ratio, EPS, which is earnings per share, or whatever you prefer looking at, however you try to quantify your purchases. But despite all of them looking right, you have to remember that the market is a dynamic entity. It changes by the day, by the minute, really, and may not always agree with your chain of thought. When I'm saying the market, I'm talking about the entire market. I'm talking about millions of investors, people's psychology, big money managers, the big money, the small money. Everybody comes together and tries to agree on the price of different stocks. And sometimes you may have a very strong case, but it may be months or even years before your thesis or your ideas come to fruition, if ever. And GME is a perfect example of this, wherein one guy had this idea that, okay, I think GME is worth a lot more than what it is right now. And this is in 2019, which is about 2 years ago. And he threw a large portion of his money at GME, and he just kept it there. He's like, one day it's going to boom, one day it's going to boom, one day it's going to boom. All of 2020 passed over. He didn't flinch, and January 2021, he's made 100-fold return, or I think it was like 150-fold return. He turned his 50 grand into 48 million at one point at its peak. And of course, he's still in the green. So I think he's a strong value investor, and it's a bad example to take, but it's an example nonetheless. So, as the market may not always agree with you, it always gives you the opportunity to buy and sell these shares where you can find the minor inefficiencies. The market is almost perfectly efficient. Like everything you can think of is priced in. You got the vaccines that you think of priced in, the UK market opening priced in. I look at, my Reddit, and people like, oh, what's the next big stock to buy, or whatever. There are ideas out there, but almost anything a normal person can think of is almost always just priced in, especially with the big stocks. But once in a while, you will get a minor inefficiency. You will see a drop or a raise wherein you can either sell the stock, as in short it, when there's a unreasonable rise, or where you can buy a stock, when there's an unreasonable fall. And you can actually profit of the difference or the inefficiency that's just occurred. And that's what trading basically is. It's trying to find where you think you can squeeze out that last bit of margin, minus your expenses, and where you think over a day, over 5 days, you've got day traders which trade intraday, which is within a day. You've got people who hold and buy for weeks, months, years, whatever. And that's where trading comes into play, wherein you buy and sell where you find an opportunity, so to speak. So I think that's about wraps it up. And I think the takeaway for this is has to be like the market can remain irrational far longer than you can remain solvent. So when you're betting against the market, you got to be very careful as to what you're doing, or else you can lose a lot of money really quickly. As the GME shorts learned in the last few months. So yeah, as mentioned, the slides will be up soon, and you've got all the references that have helped me learn. I think Morningstar, Yahoo Finance, and other stock screeners below are very good at trying to understand what the different terms are, and you can obviously read up, Google them, what PEG and whatever is, and you can see what suits your own style, because everybody has their own style of going about their business. And if you're trying to force something on yourself that you just don't like or isn't intuitive to yourself, you're just going to keep making mistakes, which won't be very nice, especially as you lose money in real time. So yeah, that's it for today. Thank you once again for joining in. I think the next couple of episodes, I'm not sure when it's going to be. I haven't got a schedule for the next 3 or 4 episodes, but it will be on my socials over the next couple of days. So just keep an eye out for that. But yeah, thank you once again for joining in. We're just going to talk about indexes next time, and then index funds or other funds just after that. And then my favorite bit, which is derivatives. But anyways, I'm getting ahead of myself. Thanks once again. Yeah, cheers. If you've got any questions, you can put them in chat. We can talk about it for a few minutes. If not, feel free to the meetings. You can leave the meeting if you choose to. Brilliant. Thanks once again.
Thank you.
Cheers. Bye bye.
Cheers.